Samvardhana Motherson reported a weak June quarter. Profits fell by nearly 49%, margins contracted as well. All of that could be pinned to tariff-related uncertainties. We're joined by COO Pankaj Mittal and CFO Kunal Manali to break down all these numbers. Thanks a lot, gentlemen, for joining in. Let's come across to you, Pankaj. There is a fair amount of uncertainty. So, instead of asking you about the quarter went by and what is likely ahead, because it's anyone's guess as of now, you've often said that majority of your US sales are USMCA compliant, which will have no tariff impact. And, if you could give us a sense on what proportion of your actual sales come in from the US, that's primary. Secondly, what proportion of your sales which are to clients outside of the US through secondary exposure have, US exposure? And what proportion of that is USMCA compliant and what isn't? Just plain numbers.
So, good morning, and thank you for having us on the show. As we mentioned earlier, most of our supplies are USMCA compliant, and they remain so, and therefore there has not been much impact of tariffs on us. Even the exports from India also are mostly, they are just about $10 million in this quarter, and most of them have had no impact because they are all ex-factory. In terms of the small percentage of the part of the supplies which we do in US, which is non-USMCA compliant, the tariffs are being passed on to the customers, and it's impact of a lag because the tariff rates themselves were not decided on what will be applicable on which commodity, how much. So those agreements are in process and they will all be passed on. So mostly we do not expect any impact or any major impact on our business from the tariffs. So that has been a very big strength of the business model of Motherson, that we are local globally. And this quarter shows the resilience and the agility with which we worked to take care of the disruptions in the market, because many of the customers around the world, and especially in Europe, also had to rejig their powertrain model. So we are a powertrain agnostic company, but still we had to also make some structural changes to take care of the new models which are taking shape and to support our customers.
So just let's get a couple of numbers out of the way. What is the exposure to the United States, firstly? And how much of that is imported into the United States? Because, on one end, people will say there's no impact of the tariff, but then there could be demand hurt as well. So tell us that.
We do not see any demand. If you see the secondary, that will be through the car maker. So if we supply to the car makers in another region, and those cars were being imported into US, we do not have a number to that. But with most of the agreements being done between, say, Europe and America, UK and America, so those impacts will also get, because it's now stable and the car makers can take their decisions. So that stability will come in. So I don't have those numbers to give you as to exactly how much is a secondary import into the market, because that's through the car makers' imports.
All right. And primary of your overall exposure, how much is US? How much of that is USMCA compliant? You say majority. If you could put a number, that would bring a lot more clarity to the street, sir.
So more than 90% of our business is USMCA compliant. I will pass on to Kunal if you have a very specific number, Kunal, to give on that, because our understanding is there are certain parts which we use in our products which are also customer nominated, and therefore those were the ones which were not USMCA compliant. Kunal, I passed on to you.
So 19% of our revenues come from the US. Around about 90%, as Pankaj was mentioning, would be USMCA compliant. Mind you, we do have 25 odd facilities in US as well. So not that entire turnover that we're doing in US is coming as imports into the US. So there's a fair amount of manufacturing that does occur in the US itself. And whatever is getting imported, a lot actually moves from Mexico and hence is USMCA compliant. There are some parts which do come from other parts of the world as part of the overall customer supply chain. And hence those are the set of parts which are to be passed on to the customers as and when the final agreements happen, which is work in progress, because I think there was a lack of clarity at the customs end on what should be the actual tariff on these parts. And as those get clarified, I think it is a matter of time before those will also get passed on to the customers.
All right. A lot of the clients that you cater to, they've cut their guidance for the full year, be it Toyota, Traton, you have Mercedes, Ford, a bunch of them. Kunal, could you give us a sense on what kind of revenue can you grow this year because of all this uncertainty and your clients facing demand challenges? And on margins particularly, would you have any guidance?
So look, on the demand front, as we had highlighted in the last quarter as well, Europe in particular was facing a bit of stress on some of the OEMs, which were all focused in EV segment, and that segment was really not the ones which were growing. And they hadn't invested in the ICE and hybrid portfolio. Having seen that, I think we had also highlighted that the OEMs are working towards creating a new set of portfolio for both ICE and hybrids, which is then expected to come out sometime in H2. And hence, we do expect that some of these underperforming OEMs will start showcasing better performance as the new launches happen in H2. In the meanwhile, keeping in mind the changed environment in Europe, we had done transformative measures announced in April, where we had said we would be, going after a cost block of around about 50 odd million euros. Part of this has happened, in which case we have booked a cost of 14 odd million euros in this quarter itself, and this would have a payback of less than a year. So as we move through the quarter into the H2 part of this year, we should be able to see a sharp ramp up on the profitability as well, aided by multiple factors actually. So one, as I just mentioned to you, the transformative measures will start showing some signs in there, though a lot will also come in FY27. In addition, we do expect H2 demand volumes to look much better in some of the traditional OEMs as they bring out new set of vehicles. Three, I think some of the tariff-related pieces for which we have taken the cost until now, those will be passed through to the customers and hence will improve the margins in the latter quarters. Fourth, I think many of the new greenfields, like the large consumer electronics one and the 10 odd that has been implemented last year, those will be ramping up, which will again be aiding profitability, which today would be at pretty much meager profitability as the ramp ups is occurring as we speak now. So again, latter quarters will show that impact. And finally, some of the acquisitions that we have done, the integration of those should also help. And I just want to highlight from a growth perspective, the non-automotive part of the business, irrespective of how the auto does, is growing at a very sharp click. This quarter, we have seen a growth of around about 40% on the non-automotive pieces. And that is where a large chunk of our growth capex is also going.
And how do you expect that mix to shape up, auto and non-auto, even as there are headwinds in the auto space, non-auto growing 40%? I'm sure the contribution increases from here on. And I specifically asked you about this year largely because, the last time you joined us, you said that FY26 will grow better than FY25. And FY25, you grew upwards of 15%. And you also said margins would expand. First quarter, that hasn't happened. So that puts the pressure on the next 3 quarters for you to perform, which is why I wanted your thoughts on, once again, the overall outlook for the year.
Yeah, absolutely right. We do expect that we should be able to do better than what we did last year. The quantums around it is a function now of multitude of different variables which continue to be at play. Like this quarter, I don't think we had anticipated any geopolitical issues with regards to Iran and Israel, and that had a significant impact on how both our working capital played out, given we had to keep again safety stock to manage it, and how the freight rates went again sky high, which meant we were bearing additional cost, which is all then part of the conversations we need to have with the customers during the year, and hence, again, the latter part of the year should be looking much better.
Okay, all right, gentlemen, thanks a lot for joining in and filling us in with your insights in terms of how business is shaping up. We look forward to chatting up with you all as the quarter progresses. For the time being, though, we'll slip into a short break, come back, we'll continue to focus on markets and stocks that are bobbing around.